Hello, I'm Mark Shine, Research Director at the Australian Accounting Standards Board. Welcome back to our second session. So the title of the second presentation is Presentation Prominence, Does It Matter to Non-Professional Investors? The Case of Other Comprehensive Income. The research team on this particular project was Dr. Troy Yao and Associate Professor Tyge Kummer, both from Queensland University of Technology, and Associate Professor Majella Percy and Emeritus Professor Jenny Stewart from Griffith University. So I'll just provide you with some a bio for our speaker, which is Dr. Troy Yao, who will be making the presentation. So Troy is a senior lecturer in the School of Accountancy at QUT Business School. He holds a Bachelor of Commerce with first class honours in accounting, the University Medal, that's all from Griffith University, along with a PhD in accounting from Griffith University, and a postgraduate certificate in academic practice from Queensland University of Technology. Troy is a member of CPA Australia and a fellow of the Higher Education Academy. Troy teaches courses focused on financial accounting standards and financial accounting theories, with a particular focus on understanding the contemporary financial reporting issues. Troy's research focuses on the interpretation of accounting standards, executive compensation, the audit pricing decisions, and corporate governance. He's published in several academic journals, and his research has received Best Paper Awards, and some of his work has been funded by through competitive external research grants. So I now call upon Troy to start his presentation. Thank you very much, Troy.
Thanks very much, Mark, for the introduction. Good afternoon, everyone. My name is Troy. So I will be presenting our research project titled the Presentation Prominence, Does It Matter to Non-Professional Investors? The Case of Other Comprehensive Income. So first of all, I would like to acknowledge the significant contribution from the research team, including my colleague, Associate Professor Tyge Kummer, and Emeritus Professor Jenny Stewart and Associate Professor Majella Percy from the Griffith University. I would also like to thank the AASB Academic Advisory Panel, who made constructive feedback to help us finish the project and to improve the project. So I would like to thank the Professor Stephen Taylor and Professor Paul Mather and Professor Michael Bradbury. All right. All right, so please go to the next slide. All right, so the revised conceptual framework published in 2018 actually states that the statement of the profit and loss is the primary source of information about entities' financial performance. So in 2020, the International Accounting Standard Board has sought the feedback on the exposure draft about the general presentation and disclosure, which aims at improving the way the information is communicated and presented to the users. So one of the issues identified in the exposure draft by the AASB back in 2017 is the issue regarding the disaggregation of the reported information. So stating that investors may find it difficult to unpack information or reported information when it's lumped together with insufficient labeling and explanations. So in this research project, so we are interested in investigating so whether that the financial information of financial performance, or how information on the financial performance is presented will have an impact on the decisions of financial statement users. Okay. All right. Next slide, please. So as one of the important components of comprehensive income, so the other comprehensive income has attracted a lot of attentions and controversies. The concern is that, allowing some items of other comprehensive income, for example, the changes in fair value of available for sale financial assets, and include those in the core business performance indicators, may confuse the non-professional users of financial statements, because some people see OCI items as a black box or dumping the ground for the controversial items, and a lot of those items are not well understood by the users. So for example, some of those OCR items must be recycled or not recycled. So the concepts of recycling is not well not understood by the users. So therefore, it is important to make the OCR item more useful for the users of the financial statements, improving the decision usefulness, objective financial reporting. So what motivates us to do this project? So as I mentioned in the first slide, there was a call by the International Accounting Standard Board to investigate or to get some feedback on how information, and please go to the next slide. Thanks. So how the information presented in the OCI statement has an impact on the users' decisions. So one of the proposed changes by the AASB is to have some additional changes to the labeling and ordering of OCI items. So specifically, AASB, again, back in 2017, proposed a couple of changes. So firstly, introducing a new label for those OCI items that are currently not recycled, and rename it as remeasurements reported outside profit and loss, and then adding a subtotal called income after remeasurements reported outside profit and loss after the category A, and then and calling the remaining OCI items as income and expenses be included in the profit and loss in the future. So in this research project, we aim to respond to the calls from the AASB about the ways that we communicate information regarding the OCI, and we realized that our limited research in this area as well. So we aim to, from the academic point of view, we aim to fill the gap in our study. So why do we focus? Next slide, please. So why do we focus on non-professional investors? We've got two main reasons that why we look at the non-professional investors. So given the complexity of OCI items, investors will determine how much OCR information to use into process. However, it is not an easy task for non-sophisticated investors or non-professional investors because they have limited knowledge of financial information, firstly, but also the presentation format of the financial statement provides some signals about the nature and importance of comprehensive income information. So therefore, our study focuses particularly on the decisions made by the non-professional investors. So next slide. Just a bit of summary of what has been found in the academic research about the other comprehensive income. So the first stream of studies looks at the value relevance of the OCI items. So value relevance studies particularly looks at whether a financial statement items are associated with stock price reactions. So if a particular financial statement item or items cause the price reactions, then we would see that the item of financial information or financial statements is value relevant. So in other words, those items are used by the users, particularly investors. So generally speaking, the literature suggests or shows that the other comprehensive income is less value relevant than the net income. So the possible explanations include that, the comprehensive income is less predictable. So they are considered as the weak performance indicator for the firm. There's also argument that the OCI components can be transitory, okay, which means that, again, it is very difficult for investors to make that precise predictions about the firm's performance. Okay, so overall, those studies suggest that OCI items are less used or less relevant or value relevant. Next slide, please. So, however, many studies have also found that particular types of items of OCI components are more relevant or value relevant than the others, including the foreign currency transaction adjustments, fair value adjustments and assets revaluations, and cash flow hedges, and also unrealized gains and losses on available for sales. So those items of the OCI statements are particularly more relevant than the other OCI components. Next slide, please. So the OCI items are also found to be associated with a greater earnings volatility. As I said earlier, a lot of OCI items are transitory, which means that it is very difficult to predict, and which leads to a high earnings volatility. As a result, it increases the adverse selection risks. Okay, so it increases the risks of mispricing. Next slide. So I guess the couple of studies that I'm looking at or talking about now are particularly relevant to our current project. So there are a numbers of studies that look at the presentation prominence of the OCI statements. So some of the studies firstly find that the OCI or other comprehensive income and components are more decision useful when they are reported in the performance statements rather than in the changes in equity. So we know that there were options prior to 2011 that some of those OCR items could be included in the changes in equity rather than the performance statements. So research suggests that, you know, when OCR items are included in the performance statements, they are more decision useful rather than being included in the changes in equity. Next slide. So there are also options under the current IAS standards and equivalent in the US standards that the OCI information could be presented in a single statement or two separate statements. So basically, the research suggests that the information presented on, you know, this is sort of mixed results from the research area. So some studies find that, for example, using a single performance statement reduces the likelihood of earnings management and increasing the earnings quality. And some other studies find that presenting the information in the two statements, you know, increases the value relevance. Okay, and Juan 2021 find that, you know, when firms moving from the two statements to a single statement, the value relevance reduces. So collectively, I guess I wouldn't say that a consistent evidence, but there are a lot of evidence suggesting that investors may prefer the information being presented in a two separate statements. So that's the statement of comprehensive income. Next slide, please. So to explore, to investigate our research question, we use that experimental design. So an experiment using a 2x2 between subject design is used to, again, to investigate the impact of a presentation prominence on the investor's decisions. So we manipulate the, you know, the experiment instrument at two levels. So we manipulate the labels, you know, either using the proposed new label for the OCR items or using the existing labels for the OCR items. And we also manipulate the financial position variable at two levels. So, you know, some information, so we assume that some firms reported at a profit, okay, that's positive net income. Now the firms made a loss, okay, for the year. So the reason that we use the experimental studies is that that will that type of research design has been able to address the issues in the you know, behavioral accounting areas. Okay, we would like to understand how investors make the decisions in regards to, you know, how information is presented in the financial statements. So we believe that using the experimental design has its own advantages. Next slide, please. So our participants, we've got 128 non-professional investors from the United States recruited from the Prolific. So the Prolific has been widely used in academic research. And the reason that we use the US-based investors is because currently US GAAP doesn't mandate the use of existing or either proposed new labels for the OCR items. So therefore, we believe that US-based participants are less likely to provide a biased response because they are not familiar with either reporting format. So in other words, if we use the users from the IFRS adoption countries, you know, they may have, you know, get used to that existing reporting format that been mandated by the IAS or AASB standards. So next slide. Just a bit of demographic information about our participants. 77% of them have investment experience of up to 10 years. And 71% of them are male, and the average age is around 35 years old. And majority of them had either bachelor, master, or doctorate degree, and almost half the participants invest in retirement savings in terms of the investment strategies. Next slide. So basically, we've got two hypotheses. So hypothesis one, predicts that those non-professional investors are more likely to use information for OCI when they're presented with the clearer labels. So next slide. So I quickly show you how we manipulate those variables. So this slide shows you the manipulated income statements and new label versus existing label while holding the net income as positive. Okay. So what you can see from the left table, that's one of the four versions of the financial statements and being randomly assigned to the participants. So this table on the left adopts the existing labels and format. So you can see that we name those items as items that will not be recycled. Subsequently to the profit and loss, or items recycled subsequently to the net income upon derecognition. On the right side, we change the new label, which are the remeasurements reported outside profit and loss, and obviously we added the subtotal. Okay. And we've got also that new label, the income expenses, to be included in the profit and loss in the future. So what we are interested in understanding is that, whether the changes in their reporting format or changes in their labels for the OCI items will have impact on the investors' decisions. Okay, next slide, please. So similarly, we're also looking at the new label versus the existing label. But in this scenario, we're holding the net income positive. Okay, next slide. All right, so our research is based on that psychology literature that proposed a model called inclusion exclusion model. So which suggests that how information is categorized will have a significant impact on how information is processed by the users. So we believe that if the informations are, of information on OCI items are well categorized, okay, with a clearer label, it will actually save a lot of time, or will lower the cost of information processing for the non-professional investors. So in other words, we predict that, if OCI items are labeled with, are categorized with clearer labels, that will, improve that decision usefulness objective of financial information. Next slide. So also you've noted that in the new reporting format, now we've there's additional subtotal items that's been included in the OCI statement, which will distinguish between items that will be included in the P&L and those that will be included in the future. So we believe that this subtotal item or subtotal line of item will again set a boundary between that two categories of OCI items, again, assessing that decision usefulness of that information. All right, next slide. So the second hypothesis looks at whether that decision usefulness of the OCR items with regard to the new labeling, depends on the financial position. So we argue that if the firms made accounting loss, the investors are more likely to investigate the reasons that why firms made accounting loss, and they're more likely to explore a little bit more about the other OCR items. So we argue that when a company report a loss, the non-professional investors are more likely to use OCI when presented with a clearer labels. Next slide, please. So so that basically shows that we compare existing and new labels when holding the firms reporting both a negative income. Next slide. So we run the online experiment. We asked investors to assume they were an investor, okay, for a fictitious company called XYZ Limited. We provide some brief information description of the company to the users, and then the process and the users, participants are randomly assigned with one of those versions of financial statements, of the OCI statements, and the process, and they are going to answer a couple of questions. Next slide. So they were asked about 4 questions. So they were asked to make 4 decisions. Strengths of the company's financial performance, magnitude of changes in financial performance over periods, and the risk of investment, and the weight assigned to OCR when evaluating the performance. So all the questions are using the scale of 1 to 11, and we ask participants to rate each question. Next slide. So we did some manipulation check to make sure that the investors understood our survey questions or experimental questions, and manipulation checks went all good. So with regard to the statistical analysis, we used a novel, which is a one-way analysis of variance to determine whether there are any statistical significance between the means of, independent groups, for example, new label versus existing label groups, or there are any statistical significance or difference between that negative net income or positive net income conditions. Next slide, please. So basically, our results shows that, for example, the perceived impact of OCR items are labeled, or how they are labeled, has an impact on the decisions in terms of evaluating firm performance. So we find that the new label conditions, also investors assigned to the new label conditions made a much clearer decisions in terms of evaluating the firm performance. And the novel stats also shows that there's an interaction effect between the new label and the net income condition, supporting our arguments that when information are presented clearly with a clearer label, and if the firm incurred particularly a loss for the period, and that the decision usefulness of OCR items has much been improved. Next slide. So similarly, we find consistent results that show us, we find the results a significant main effect for the format variable new label on investors' assessment of magnitudes of changes in the financial performance, and also investment risk. I'll show you that in the next slide. So all the p-values are statistically significant. So which supports our arguments that when, you know, if again, when a loss is reported in the income statement, users are more likely to pay attention to the components of income and to identify reasons for the loss, and particularly when the OCI are presented in a way that is easier to understand. So under our new label conditions. All right, next slide. I've talked about this. Next slide, please. All right, so the last the last question is about the importance of using OCI information. So again, we find that, again, the both significant effect of format and significant effect on the net income. So the plotted data illustrate that direction of effects that is consistent with our ANOVA results. So in addition, the results of ANOVA shows a significant interaction between two independent variables. That's a new label times the net income. Again, suggesting that proposed new label enhanced decision usefulness, particularly for the firms that incurred a accounting loss for the period. Okay, next slide. Just to conclude, our paper provides evidence on communicating information about the financial performance and has been taken into consideration by the AASB and AASB for feedback on exposure draft on general presentation and disclosures. So particularly we're focused on providing feedback on the questions and investigate the presentation prominence of the OCI items, whether that the presentation format of prominence impact on decisions of the non-professional investors. Okay, so we find that non-professional investors are more likely to use OCI items when they are presented with clearer labels or labels that enable them to better understand those items. And we also find that investors perceive OCI to be relatively more important, especially when the entity reported a negative income. So future research can sort of expand our research into looking at the impact on the professional investors particularly, and we also could expand that research evidence to other industries, for example, banking. All right. Thanks, everyone. That's the end of the presentation.
Thank you, Troy. Now we'll move to our facilitated panel session. So what I will do is I will introduce each of our three panelists, and then finally I'll introduce our facilitator, Toby Langley. But let me start with our panelists. So the first panelist is David Wilson. So David is Deputy Head of Australian Equities Growth at First Sentier Investors. He's responsible for managing the wholesale geared shared fund and coverage of the diversified financials, insurance, steel and chemical sectors. Prior to joining First Sentier Investors, David had a variety of roles at UBS, including managing the equities research, equity sales and family office businesses. Throughout his time at UBS, they consistently ranked #1 in equities research and sales by Australasian fund managers. Prior to joining UBS, David worked at JP Morgan Ord Minnett, where he was the #1 ranked telco, transport and industrials analyst, and where he was also head of equities research for 4 years. Our second panel member is Mark Smith. So Mark is National Australia Bank's Head of Accounting Policy and Assurance. Mark leads a number of teams that are responsible for the bank's statutory and management reporting, including financial control, accounting policy implementation and transaction advice. Mark started his career in audit with Ernst & Young in the Netherlands, where he specialised in the financial services industry. After having worked in audit, Mark has worked in a number of financial reporting roles with banks in the United States, Europe and Australia. And he was a past board member of the Australian Accounting Standards Board for the period 2014 to 2018. So thank you, Mark. And then our third panelist is Rob Sharma. Rob is Head of Accounting Services at the Australian Prudential Regulation Authority, APRA. And APRA is a prudential regulator of the financial services industry. It oversees banks, credit unions, building societies, general insurance and reinsurance companies, life insurance, private health insurers, friendly societies, and most members of the superannuation industry. APRA currently supervises institutions holding $6 trillion in assets for Australian depositors, policyholders, and superannuation fund members. Rob has worked on a range of accounting and auditing matters for APRA across the last 15 years. Now, our panel will be facilitated by one of our board members, a AASB board member, Toby Langley. So Toby leads Xero's investor relations team and is based in Sydney. Listed on the ASX and domiciled in New Zealand, Xero is a global cloud-based accounting and small business platform. Toby has nearly 2 decades experience within the fields of accounting, equity research and investor relations. Prior to his current role, Toby was head of Australian financial research at Bank of America. He has also held a number of other senior equity research roles in the UK and in Australia, covering the insurance, diversified financials and banking sectors. Toby has contributed to a range of accounting working groups within the International Accounting Standards Board and the Australian Accounting Standards Board, and has been a speaker at various industry events on effective investor communications and financial reporting. So I'll now turn to Toby and to the panel, and there'll be some discussion there, which will be off the back of what we've of the presentation that we've had, but also possibly getting into other matters of, when I'll say storytelling, but financial reporting storytelling, both from a preparer, regulator, and a user perspective. So thank you very much, Toby.
Thank you very much, Mark. And I wanted to say, first of all, congratulations to Troy and the team for the paper and the interesting presentation that they've made today. I also wanted to thank all of those of you that are attending online, and of course our panelists, David, Mark, and Robert. We're going to spend the next 30 minutes discussing a number of the areas that were raised in the paper before we then move to a Q&A session that'll give you an opportunity to ask questions. You don't need to wait until then, and indeed I encourage those of you that are interested in asking questions to put those in the chat that's accessible through the Zoom webinar. You can do that at any time, and if you're keen, we're certainly very interested in receiving those. So please put them through. I want to start the panel discussion by asking the same sort of question essentially to all three of our panelists, and that's really to start with thinking about OCI and what the value of it is to you in your role. And so I'll start with you first, David, please, as an investor. If you could maybe help us understand better how you use OCI and how you see investors using the information presented within the OCI statement.
Okay, no, thanks for the question, Toby, and thanks for the opportunity to come and talk to everyone today. I think where we come from when we look at OCI, and I can only talk as a professional investor, both having been a fund manager, both as a fund manager and historically as a stockbroker, is that I think that generally it's an area that's not focused on by the market and by investors, but it is from time to time, and I think it's probably when it matters. So when investors look at financial reports, they spend most of their time looking at the income statement and the cash flow statement, and even also the balance sheet as well. And OCI sort of feeds in at the sort of bottom of both the income statement and the balance sheet, if you like. And so where there are large movements And as Troy talked to, particularly when there are losses, then I think it does focus the mind. And I think also the other area where the balance sheet matters for regulatory reasons, or for sort of debt covenants or issues of that matter, then also the movements in OCI matter more as well.
Thank you, David. And maybe if we move to Mark and getting the flip side to that comment, really from the perspective of the preparer telling the story, how do you feel the OCI is positioned?
Thank you, Toby. Look, I do think OCI is relevant in understanding the entity's performance. And I do think it is different from amounts in the income statement. So let's talk for a moment about why it is different from amounts in the income statement. Well, I think of OCI as something that relates to something that is not yet finalized. And I use the word here finalized as opposed to realized. And we probably at some point will come back later to sort of that difference. But we know that realization is not necessarily the driver. So I use for now, these matters are not yet finalized. And they remain subject to sometimes certain business decisions, and therefore still subject to measurement changes that will be ongoing. They're also different from income statement amounts because a company generally wouldn't consider these balances or these numbers in, let's say, dividend decisions, current dividend paying capacity, but they are important for longer term indications about liquidity, solvency, and those types of matters. So as a preparer, I am a supporter of other comprehensive income, as I believe that not all changes in asset and liability carrying values should go through the income statement. And I still need a place to essentially record these changes. And that is where OCI is coming in. Maybe two more points that I want to make, Toby, are that I do see this discussion about OCI also as related to a discussion about measurement basis. So for example, fair value measurement sometimes leads to sort of almost like a compromise to recognize amounts in other comprehensive income. And I think that mostly happens when, let's say, that fair value measurement basis is not necessarily reflective of an entity's business model. And so as a preparer in those cases, I have to admit that I still find often the fair value measurement basis more relevant. And on the flip side, therefore, I'm also prepared to deal with some of the OCI, let's call it complexities and inconsistencies. And maybe if you allow me, Toby, one last point, I guess, that was sort of on my mind when I was thinking about this. There's actually some examples where preparers prior to certain OCI decisions that have been made in recent years, basically added additional disclosures to address some of the, I guess, perceived issues. And most notably here, sort of the own credit risk matter is on my mind. And, during GFC, certainly financial institutions did have sort of counterintuitive amounts running through the P&L relating to own credit risk or fair valued liabilities. And yes, disclosures were provided for those types of amounts. But in my personal view, I felt sort of, the significance of those amounts running through the income statement really, created sort of, resulted in less trust in a way in financial reporting. And so from my perspective as a preparer, again, I think that's really the step that has been taken to put a balance like that in other comprehensive income was really a good step and helped in getting more trust again in the financial reporting system. I'll stop here for a moment. Thanks.
Thank you, Mark. Yeah, I think that's a really interesting point in terms of helping guide users to what's most relevant to them, as well as and thinking about dependability of those disclosures through time, not just at a given point, and I guess the recurring value of OCI in that, and often we're not going to think of it as being recurring in nature because it's typically one-off, but I guess we want to create a habit where people look at it on a recurring basis to at least get themselves across it. I'll move over to Robert, and the same question for you from a regulatory perspective will be valuable in terms of your perspective, please, Robert.
Thank you, Toby. In terms of OCI, it's something we do tend to focus on because it forms part of regulatory capital, common equity tier 1. So we do try to unpack the nature of the item. And if something is large or unusual, especially if it's loss-making, it's something we do focus on. We have spent some time looking at own creditworthiness at some of our institutions, and it's a very hard construct to measure. And I take Mark's point that that at least it actually helps you communicate a better story around the financial statements if certain items that are not purely in the nature of statutory profit. It lets you unpack those items and helps you understand what exactly is going on based on their nature. Just one thing about OCI that we'd like to make is that we do go through a process of actually unpacking the nature a bit further, especially if it's in the nature of a reserve, a newly created reserve or something, because ultimately from a regulatory point of view, there are certain criteria before something is recognized as equity. There has to be a certain element of permanence, there has to be certain elements of loss absorbency and the like. We want something that can actually absorb losses. So those are the kinds of top processes we go. In summary, we find OCI as being a useful disclosure, but we also try to unpack its nature, and then we also adopt a filter or a lens to understand, can this item actually absorb losses going forward? And that actually informs our decision making because our focus is on the balance sheet. I'll just pause there and on this question. Thank you.
Thank you, Robert. I think there's some great perspectives there to scene set. Maybe we'll spend a bit more time now looking more specifically at the findings of the research, and I'll go back to David. Now, as per Troy's presentation, the research suggests that investors, albeit non-professional investors, are more likely to use OCI if it is labelled more clearly. I guess in your view, how useful do you feel that the current information is in terms of how it's presented? And what, if any, changes have you observed in terms of what goes into OCI over time?
I think that from where we sort of sit is that there hasn't, we think that actually the sort of current levels of disclosure and labelling are pretty effective, Toby. What we would say is that any move to making it clearer, whether professional investors or non-professional investors, I think it makes sense, and I think sort of Troy makes some interesting points there. I also wanted to pick up on one of the points that you made also previously, Toby, is that I think actually with OCIs, I think a bit like in our world where we move to abnormal items, within sort of statutory reported profit, I think what matters a lot is actually the time series of just how OCIs have moved over time as well. I think that, whether if you've got a sort of a long negative sequence of OCIs, in the same way that in our world where we look at things, we tend to look at profits on an underlying profit basis rather than on a sort of statutory basis. But if there's again, in the same way, a long history of abnormal losses, I should say, then that also applies in the case of OCIs as well. And I think in terms of sort of changes, I think when you go through periods in particular of sort of currency volatility, because obviously that's an important part of OCIs, then that is something that will move over time as well.
Thank you, David. And back to you, Mark, as the preparer on the panel. What do you consider to be most useful in terms of what's currently required? And then, if we can get you to talk about what you see as least useful or unhelpful, any thoughts around both those points, I think will be very useful.
Yeah, Toby, I think at this stage, I will probably come back to sort of the topic of recycling. So let me sort of go back to, well, most useful. I do find it quite useful and appropriate, by the way, that currently it is disclosed what out of other comprehensive income ultimately will recycle to P&L and what possibly not. And look, I actually thought I would check this out this morning, but I don't think, and by the way, I didn't do it, but I don't think we always used to disclose that. I think that came in a particular year. I can't remember when and all that, but I think that's actually quite useful. But at the same time, yeah, there is sort of this, I think, continuing challenge. And I have to admit, I've sort of come across this when I sort of explained to, you know, let's say the CFOs and the CEOs and whatnot in my company, yeah, this element of not everything recycles, and understanding why certain things do recycle and other things do not recycle is probably the most, well, not useful aspect of OCI, I guess. And when I put my sort of somewhat at times pragmatic hat on as a preparer of financial statements, you know, I think I can understand why some of these decisions have been made. Again, sort of going back to, you know, I understand why, let's say, the matter of own credit risk, if you designate something at fair value through profit and loss, why that doesn't go to the P&L in itself, but basically when you buy it back, why that is not recycled is a little bit harder to explain, albeit, you know, that is consistent with how we treat fair value through other comprehensive income equity. There are certain pragmatic reasons, I think, that sort of relate to the impairment assessment, why essentially the standard moved to, well, or didn't go down to the path of recycling. So there are certain historic explanations why certain decisions have been made, but essentially explaining that to an outsider who hasn't been across sort of that level of detail and just thinks about the organization from a value perspective or a performance perspective is complicated, or not really based in principle. So I think that's the biggest challenge. At the same time, as a preparer, I do say, I think we have been getting used to this model for some time now, and we're sort of maybe not necessarily advocating drastic changes in this, but it remains a sore point. I think the other matter that Dave had raised before, sort of the concept of underlying profit and whatnot, is on my mind in this as well. So, for example, there are inconsistencies in how reporters sort of apply the concept of fair value through OCI for equities. And again, when I say inconsistencies, I'm not meaning inappropriate. No, these are valid choices where you either put something at fair value through P&L or fair value through OCI, an equity investment. And I think sort of how preparers deal to these matters is they would still address some of these items through essentially underlying profit disclosures and whatnot. So I guess I'm just highlighting this to sort of illustrate that we have found a way to deal to these sort of this issue if there's no conceptual principle necessarily underlying some of these items, but it is yeah, at times challenging to explain this.
Thanks, Mark. Yeah, I think there's a lot of really interesting points there in terms of we haven't had a lot of change of late, but there's probably acknowledgement that there is probably a need for a bit more development to kind of really refine how things are coming across. Robert, it'd be good, it's been building out a bit maybe on your first answer, and perhaps if you could provide some comments on how you find current labeling and disclosure useful. You know, which particular line items are you looking to sort of latch onto, and you know, where would you send your team out to do more work?
Okay. Firstly, I think it's something, Toby, it's something, and everyone, it's something we've learned to live with. It's something we've got familiar with. So basically, we look at the item, we try to unpack the item. Just like David said, we look at if there's an unusual trend, if something looks like an outlier, we try to unpack that. And then we try to look for the economic reason as to why that's happening. You know, if the markets have moved and we see foreign currency, for example, moving heavily, or there's something unusual happening with defined benefit surpluses or deficits, We try to unpack the economic reason. Is it interest rates or something changed in their measurement model? So that is something we try to do and understand before it gets included as part of our analysis process. For me, I think the hardest bit with OCI is it's a bit of a hodgepodge. And anything that can help us understand the alphabet soup a bit better would be great. Because what we do find is we see like a collection of items, and I accept Mark's point that they're not pure profit items. And I know the AASB is looking at performance reporting as well, as a broader project. And there's other disclosures on management commentary and the like for entities to make disclosures. Anything that could help us understand exactly what is driving the business and help us understand, does that actually outcome make economic sense? So we can unpack that a bit better, would be useful. And people can use a whole variety of techniques and approaches. One could be, voluntary disclosure. But the more fundamental issue with OCI is what is the conceptual basis for OCI? I mean, I think currently we've used it as, or we've evolved into a practice that, okay, it should not go into P&L, so it should go to OCI rather than what, and certain items should not be reclassified into P&L, and therefore it should stay in OCI, unless there's a certain time period and you do and then you do it through retained earnings. So I think that sort of logic or premise or the conceptual basis for the use of OCI might actually help in understanding and help us get better value from the nature of those items. And the last point I wanted to point about, and this actually picks on what Mark said, is the incentives that OCI leads to versus P&L. When do people choose to put something in P&L? And when do people choose to put something in OCI? And when do they choose to recycle items as well? So these are things that we need to think about. And if we had a conceptual basis as to what are we trying to achieve with this item a bit better, it could actually inform users a bit better and analysts. I'll just stop there. Thank you.
Thank you, Robert. Yeah, you raised an interesting point around incentives. And I guess we know where the bar is set in terms of measuring performance over time, particularly through time, as David's mentioned as well. I just want to make another appeal for questions. We have had one put up in the chat, but if anybody else is in a position to enter theirs, it'd be great to get those queued up so we can ensure we tackle those in the last little section. I'll go back to David, and more specifically around this point of clearer labeling. What's your sense on the impact that that's likely to have? I know, and are there any kind of, is there any kind of work that you do with your team to categorize things in a more bucketed way, similar to the way that the labels were presented in the presentation?
I think clearer labeling that should occur across the board. I think whether from an OCI point of view, but also from sort of an abnormal items point of view. As equity analysts, we tend to live in a sort of pro forma world, not a reported world. And so anything that allows us to go from, if you like, underlying earnings to, if you like, call it, then statutory earnings, and then back, and then further using OCIs, anything that has clearer labeling, because I actually think at the moment, particularly that labeling between underlying earnings and reported earnings is very, very variable. You've got some companies who do it very well, and some companies it's a rabble. And so therefore I think that I think across the board it should be more systematic, whereby it's actually clear how you get from what the company perceives its underlying earnings, and as you say, a lot of times that's what remuneration is based on, and then how you get that both at the, if you like, the EBIT line, the interest line, the tax line, the associates line, the minorities line, the NPAT line, back to the sort of statutory number, and then beyond that, the the OCI impact on that as well in terms of the way that feeds through into the balance sheet. I think that the clearer disclosure around that, because I think it actually matters a lot. We're all for that. And as I said, at the moment, I think it's a bit of a rabble.
Thank you, David. And I guess it's sort of picking up on that point around the rabble of disclosures and also some of your previous remarks, Mark. Are there any parts of the OCI that you'd be willing to share with us that you find the most challenging to sort of quantify, measure and report on?
Yeah, I think I can make some comments on that, Toby. I don't think I will be giving away trade secrets or anything like that, but these are probably just what I think of as common challenges for preparers. Look, I would say, Toby, in my mind, sort of when it goes into splitting changes in carrying value into different components, that is probably where the biggest challenges come up. I mean, in a way, when I need to determine a change in carrying value, let's call it for a moment fair value perhaps, but whatever type of carrying value, whether I record that in the P&L or in the statement of comprehensive income probably doesn't matter that much. But as soon as you start to split it to slice and dice it into components, it obviously becomes quite hard. And to be honest, I think most sort of preparers potentially who have resources and whatnot available to do these types of things, they can do that, well, hopefully really, really well. But sometimes I do feel for those that perhaps would have less expertise or resources available to do that. So things, again, it's a little bit financial instrument focused, sort of some of the things that I mentioned here, but we used to have hedge accounting and we put things in a cash flow hedge reserve. Okay, we start to put things in, a cash flow hedge reserve and a cost of hedging reserve. Both of these components are elements of fair value changes. And again, there's a conceptual basis to justify the separation of the two, but there's actually probably multiple ways to do this. And so, yeah, I could see how that could be challenging for certain preparers. And then there's obviously other components as well. Again, we spoke about own credit risk. So I think that's my key point, Toby. As soon as you start to break it into these slice and dice it into components, it gets operationally challenging.
Okay, thank you, Mark. I'll finish the panel discussion by flicking to Robert, just to if you can share with us any thoughts on how the regulator treats certain types of OCI differently, and the principles that maybe come behind that.
Sure. So some of the things we actually back out, for example, the cash flow hedge reserve, when it's effective, we actually back it out of our common equity tier 1, which is like the highest form of capital that we rely upon, because we see that as a something that changes and moves, it creates volatility in the reserves for the financial institution. That's one of the things we back out. Own creditworthiness is another one where we take it off. And the slight difference between what we do for own creditworthiness is for regulatory purposes, and this goes to the heart of Mark's splitting problem, is we actually remove the own creditworthiness that could occur on derivative and non-derivative instruments. So effectively, that gets backed out as well. There's also, when we look at asset reval reserves, we have a general requirement that if fair values are applied, they need to be applied under, with the appropriate valuation methodology, and the fair values that come out need to be reliable. And if they are not reliable, we have certain tools in our prudential framework that we can exercise to actually apply a regulatory adjustment. So those are the three main kinds of adjustments we tend to apply. So effectively, we start with the accounting. When we do find that we're not getting, if the fair values are not reliable or they're not aligned with the prudential framework or the design principles of the prudential framework, which has a different purpose, we tend to back those out. So it's a bit like moving to an underlying profit in some ways, but our focus is more on the balance sheet.
Thanks very much. So I want to come back to this, to the balance between the primary statements, maybe in the Q&A, but that brings to the end our allocated time for the main panelist session. We have had some questions submitted, which is great. So I'll now start going through those, but just one more appeal before I do so to those of you that are on the session. You can enter a question through the Q&A, or sorry, through the chat function inside the Zoom webinar. I'll then read those to the panelists, and we'll work that way. Anybody who wants to ask a question that hasn't, please do so. So the first question we've had is, this person is a fan of OCI. I think it serves its purpose, and it helps to not distort net income or P&L. And so the need for OCI for deferral of hedge gains and losses, or as a bucket for other items that's not recycled, like asset revaluations, etc. Or things that could be used for both. So I think it's more of a comment, really, but I think I'd be interested in your views. Just this, there was something that was raised in the research, which is this relationship between the OCI having more value when the income statement is negative. And so maybe I might actually put that one to David, and then I'll maybe go back to Troy, whether or not he'd thought about this. But David is our resident professional investor on the call. If we can maybe go to him first, and then we'll go over to Troy, please.
Yeah, I mean, thanks for the question, and yeah, on that, Toby, I think it tends to be, if there's some sort of stress, whether balance sheet stress in some of the sort of issues that Robert talks to, or just P&L stress, then if there's sort of added stress, if you like, in terms of what's actually happening amongst OCIs, then I think that actually matters more to professional investors. If you're sort of, and therefore that's actually exerting further stress back onto the balance sheet and the net worth of the company. So yes, I think I would agree with the proposition that it actually matters. It does matter a lot more, and you will look at more closely at OCIs. If the company is sort of sailing along fine and earnings are fine and returns are fine, then you may not spend a whole lot of time on OCIs. But if there's a sort of stress, regulatory stress, capital stress, whatever that stress may be, then and then OCIs only add to that, then I think they will be looked at a lot more closely.
Thank you. And maybe Troy, if you'd be interested in maybe what you guys.
I will probably, but just to add one comment that from the academic research point of view, research does suggest that firms do not have a high incentive to report a negative income, obviously, because that does lead to sort of negative reactions from the market. But if firms do report a negative income, our proposition from the research point of view is that we predict that those investors would be interested in paying more attention to the components of the income statement and to seek reasons for the reported loss. So if the items are clearly or better labeled, and to help users to better understand the impact on the P&L or future P&L, then it will actually assist in the decisions.
Thank you, Troy. So the next question we have is from Neil, and it's: how important is it to have the same standard OCI line items and labels each year or over a period of time in order to unpack what is transient and what is recurring? Or is it better to give or to continue with companies being allowed to have a more sort of ad hoc, flexible way of providing the voluntary disclosure there? So maybe I'll, with that one, go to Mark to get his views first, and then if anybody else wants to pitch in as well.
Yeah, thank you, Toby. Look, yeah, I think it's an interesting question, and I was just reflecting on that. And look, I guess from my perspective, I'm thinking of this as well. I don't think preparers, at least the ones that I'm most familiar with, wouldn't necessarily chop and change sort of the line items in this that much. I think if you would look, let's say, at a set of financial statements across a number of years, for a particular preparer, I would almost expect that those line items are relatively stable, unless there will be a new category introduced by a new standard, or unless there is, well, and I'm probably not using a most appropriate sort of accounting standard word here, but unless there's a new business model or a drastic change or whatever occurring, I don't think there would be a lot of going back and forth. And maybe, if you allow me to make a further comment on this, but it's a little bit, it's related, but not immediately OCI in first instance. But so I think in this conversation, we have a few times touched sort of on the concept of underlying profit. And maybe that's what more comes to mind for me as to, well, that's an area where I would be extra alert, I guess, that there is no inappropriate sort of change in course, and one year things are in and the other year things are out. But I haven't been thinking of other comprehensive income in that nature. But would be interested to hear the perspective of others, or whether anything has come through in the research that you did, Troy, of this matter.
Troy, have you got a response to Mark's points raised?
Well, I haven't quite. I mean, again, it's a good question that I haven't really thought about. But I think that the voluntary disclosures can be a solution, because obviously one issue is identified in the academic research is that OCI leads to high earnings volatility because some of the items are more transitory, the others are less. So again, I don't know what exactly that we should propose for the policymakers, but I think that voluntary disclosures can be a solution, and that's something that we haven't sort of considered in our sort of research design point from the research design point of view, that I haven't really tested about sort of recognition versus the disclosures, and that's probably something we could look into further in the future from the research point of view as well.
David, from your side, would you prefer to see something of a standardization, or do you prefer to kind of group items under your own steam, so to speak?
I'm sort of a bit agnostic. I guess we probably prefer sort of clearer disclosure, so not sort of grouping. I think so you can actually understand, if you need to understand the nature of these things. I would prefer that.
Thank you. Now, Robert, I'll come to you first on this one, but again, I think it's one that would probably work for a number of the panelists as well as Troy, and it's around this point that was raised in the discussion on incentives, and in particular, if there's some discretion as to whether or not an item is directed to OCI, is that action used to protect the P&L or indeed the balance sheet, depending on how it's being treated. And therefore, sort of that might be an interesting point to just expand on a bit further, perhaps. But more specifically, if sophisticated investors are in a position to fully unpack the actions that management are taking, then why would anybody bother to sort of try and game the system in a way in terms of picking and choosing between income statement and comprehensive income? I'll put that one to you. It's a slightly controversial question, but
it's a fair question. I think there's an incentive piece, and the choices you make can drive a lot of behaviors. And it also comes out if you've got shareholders and you have to pay dividends, you're going to focus on your statutory profit line or cash earnings, whatever basis you're going to use to pay those dividends. And some of the choices you make could be driven by that. But there's also a double-edged sword. If you put something at fair value through P&L and you're effectively betting that the value is always going to go up, so you're going to actually pay dividend out of latent gains. But there's also the chance that the latent gains could swing the other way. Just on this point as well, when we look at P&L and balance sheet splits, I think the P&L in its pure, we look it's good to look at an entity, but also look across entities and look across entities across time, in a peer group. Because some of the accounting policies are quite actually meaningful in understanding what's driving the true value of that company. And from a regulatory point of view, we tend to look at both the P&L and the balance sheet. Obviously, the balance sheet is something we place more emphasis on, but the P&L can be just as informative. For example, if there's something going, is there a shock? Is there something going wrong with the business model? We try to understand that, and it gets crystallized in the P&L. And sometimes, we have certain other lead indicators which we know could come through the P&L across time. So what we do is tend to actually look at the whole incentive picture. And again, there's remuneration tied to certain P&L numbers. There could be a whole range of other incentives. So we try to unpack the whole incentive piece more holistically. But I do think the P&L and balance sheet presentation issue is just one part of a broader game that is played. It's not just, it is not the only game. There's a bigger story that is being painted with it. So it makes sense to have that, to understand what's happening. And I'll be able to unpack that.
Thank you, Robert. And maybe David, just in your experience of from the perspective of being an investor, whether you've seen any sort of systematic or otherwise sort of attribution between OCI and income statement and or balance sheet in that regard around incentives is
it's an interesting question, Toby, because when we see it and if we think the company is arbitraging and manipulating it and moving it from one area to another, that almost counts double negative against them if they're trying to arbitrage it, because you're going, why are they doing this? What are they hiding? And so we do, and I guess I would like to answer that question on the basis of 3 layers of underlying statutory and then call it statutory plus OCI. So when numbers are moving between those numbers and where you're getting accounting is being used to sort of generate particular outcomes, then we are very, very attuned to that. And I think it actually matters because it also often can go to the sort of culture of the particular company involved as well.
So, I mean, maybe you never got quite as granular as thinking about incentives, Troy, but a sort of linked question is, how do you feel from your research that the sort of private or non-professional investor is how are they really thinking about OCI? What's the use case for them?
Yeah, I mean, from the academic research point of view, there has been a massive literature talking about reporting incentives. For example, when we talk about standards adoptions and things like that, obviously we can't expect a standardized accounting practices throughout different countries or throughout sectors, because of precarious reporting incentives. So I think reporting incentives definitely play a very important role in driving how information is presented to the users. With regard to the OCI, as I said, again, research generally suggests that users don't quite understand a lot of complex OCI items, and particularly, the concept of recycling, and that sort of supports the comment made by Robert about and other panelists about we need a better conceptual sort of framework to look at the OCI items. But I mean, there are actually a few papers to look at how presentation prominence will actually help prominence of OCI items actually help, for example, help analysts to detect earnings management or potential manipulations. There were also studies looking at the how presentation format of OCIs helps the investors to detect the again, earnings manipulations and things like that. So I think that on one hand, the preparers do have the incentives to report information, but again, how information is presented or reported to users will actually also influence on how the user is going to use that information, or maybe they are able to detect the potential opportunistic reporting behaviors or things like that.
Thank you, Troy. The next question we've had in the Q&A box is whether or not we've got any views on the panel on non-recycling of fair value through OCI of equities under IFRS 9, and whether it should be allowed. That's maybe a good one for Mark to start with.
Yeah, look, it's certainly something that financial institutions and no doubt other preparers have been thinking about a long time and often, and have been many debates on this topic, I guess. Look, I'm probably, again, I would prefer that there is a conceptual framework that sort of addresses these types of questions, I guess. But in the end, I'm still at this stage not losing sleep over this or getting overly concerned about it. Because I guess sort of even thinking about the question that was asked previously, and sort of I do note that most were sort of thinking about this in the context of earning management and whatnot. But I guess in my view, put earnings management to the side. I'm sure there will be some who engage in that. But I think the first incentive for, let's say, a listed company would be to avoid inappropriate earnings volatility that is not necessarily reflective of the economics. And so from that perspective, I am actually I can achieve that on, let's say, fair value through OCI equity instruments. I can achieve that in two ways. Either I take it into the P&L and then I explain it, what it is, and actually explain that it is not necessarily something that I consider underlying profit, and that's fine. Or the other way is basically, okay, it goes into other comprehensive income, and it will be, explained, visible in there as well. So even the fact that it doesn't recycle back, that in itself doesn't, other than the conceptual question, it doesn't disturb me that much because it can be addressed with disclosures. Yeah, I'm not sure how quickly this question will be resolved, essentially, on whether these things should be recycled or not, because I think it has been a point of discussion for many, many years, to be honest. I'm
gonna take a risk and freestyle a little bit because this isn't a question that's been asked, but I think it's one that's quite useful. So other comprehensive income is something of a bridge between the primary statements, and so the need for its existence is tacitly an acknowledgement that the primary statements on their own are not cutting it in terms of helping the user to sort of get that true holistic perspective on what's happening in the business, either in the period or in terms of its position at the period end. So I'm wondering if the panel might have any views on sort of looking to upcoming projects that both the AASB and others have in train around management commentary, and also concepts such as integrated reporting, whether or not they feel that that might help to also address the sort of nub of the issue here, which is that, again, that either the income statement or the balance sheet alone they're not enough. And whether or not that they're expecting further improvement in terms of user understanding from some of those initiatives. Maybe I'll try Robert first on this one, whether or not it's something that regulators are looking at.
I think the AASB is doing a lot of work. It's part of its agenda consultation. It's thinking of, there's performance reporting on the agenda, there's management commentary and the like. And there's also now this new sustainability standards board, which some of the disclosures will probably flow through the management commentary project, potentially, based on some of the media that's come out in the public domain. I think these are tools that are available to preparers to better inform users and investors and regulators. And I think they're going to become more and more important because the nature of things we're dealing with in a number of cases are emerging. It's hard to actually, they're not as mature, if you like, like how do you quantify, for example, things like climate, some elements like that. They only, in some cases you could be a qualitative disclosure might be easier versus a quantitative disclosure. Just, we're dealing with a lot of changing. How do you quantify some of the things around some of this COVID pandemic? They're going to be challenges. So I think the whole sort of reporting suite is something that could be useful in leveraging off as a platform rather than a single element. so that people can actually unpack what is and the underlying elements, and people can understand what is going on. And again, people that do it better will get rewarded. You know, it'll be an easier story to tell vis-a-vis those that are less transparent or have other incentives in terms of how they disclose these, what is exactly going on. So I do think I agree with you, Toby, that basically there are different platforms that you can use, and perhaps in this current world, it may be useful to think about all the various kinds of disclosures. I know in the regulatory space, for example, we also have some disclosures in banks, you know, like the Pillar 3 disclosures. And I do know banks sometimes use that. If there's certain risk-based disclosures, they make additional disclosures in that, you know, to communicate to investors and the market more generally. I'll just pause there. And
yeah, thank you. I won't ask this question to Mark because he's probably already worrying about how much extra work he's going to have to do to fulfill all this extra disclosure. But maybe from David and Troy, whether they've got hope that will lead to better understanding from users. Maybe if we go to David first and then Troy to finish on that one.
Yeah, I mean, if you just got, I mean, I think Robert makes the right point. You need to sort of, you know, if it's more qualitative, we don't really want to see that sort of qualitative, subjective view introduced into balance sheets or income statements. We'd rather keep that sort of clean as a sort of. I think it was actually Mark who said, you know, what is the sort of where we're trying to get at? Well, we're actually more a believer of an historical cost accounting, whereby, you know, that is your bedrock. It's a statement of history and a statement of fact, and so we're trying to sort of remove sort of subjectivity out of. And if there's got to be something more subjective, then actually that can be sort of placed in sort of management commentary. That's probably where I come from on this point of view. Tony.
Troy.
Well, I guess that again, from the academic point of view, some studies do suggest that investors do, again, a lot of times that they do ignore the disclosures, qualitative disclosures. They pay more attention to the things items that are recognized on the statements. So I don't know whether, I mean, as I said earlier, the voluntary disclosures or those qualitative disclosures might be a potential solution, but I don't know to what extent that investors were actually relying on those commentaries and disclosures, and, you know, consider those into their decisions. Particularly, as you said, some of those things can be very subjective and in terms of disclosures and things like that.
Okay. We did have a question, and I'm not sure who's best to answer it, but we did have a question around not-for-profit tier 3 standards around OCI. So is it appropriate to use? Is OCI appropriate for the proposed and not-for-profit tier 3 standard? And I guess users are not going to be looking to invest, but, you know, this might, for example, include a charity, but users may well be perhaps a similar sort of cohort, and whether or not that's something anybody would be keen to comment on.
I mean, maybe one thought here that is coming up is I do think it goes back to measurement basis as well. I mean, basically, if we would have historical cost measurement basis, you will have a lot less of other comprehensive income, I expect. And so and I'm not very familiar with not-for-profit, but that's sort of where I'm wondering how much fair value measurement would be occurring there, although maybe it happens with properties and whatnot. I'm not sure, actually. So I feel like it's really difficult to answer in isolation. You need to think about what is on the balance sheet and what sort of measurement basis would be appropriate for those assets and liabilities. That's probably all I can say, Toby.
Yeah, I think that's right. It's a bit of it's potentially a bit of a rabbit warren of other stuff. And I think the balance between complexity and of the disclosure and the necessary information that's going to be required to enable that not-for-profit is certainly not. It's a pretty tricky conundrum. We're almost up on time. I think I might take those questions. I might encourage those questions that are still outstanding to be taken offline, given that we are pretty much 1 minute to the hour. So I want to say thank you very much again to our panel, Mark, Robert, and David, and also to Troy and team for a great presentation at the start of the session. And on that, I'll hand back now to Mark. Thank you. Thanks for the questions also.
Thanks, Toby. And I just reiterate that those comments to the panelists and to the research team. The discussion was very interesting, and also the questions that came from the audience. And so I thank you all for that and for the answers provided. And I think it's interesting that the two presentations that we've had to date, that the first one, which was relying effectively upon hand-collected data from annual reports, and so therefore was very much tied into providing information which was relevant to a post-implementation review of AASB 15, Griffith 15, whereas the study that Troy has presented on, the fact that it has this experimental design allows the standard setter to look at possibilities which could be incorporated into an accounting standard. So therefore, part of the process of making an accounting standard. So it's been quite interesting to see the two research methods being used to address different types of questions. And so I certainly thank both the group that presented just now and also the first group for their presentation. So we're going for a break now, and we're coming back at, I'm just checking here, at, well, 2:15 will be when we start. So if you're back in about 2:10 Australian Eastern Daylight Time, and then we'll hear from the third research team. So thank you very much.